I'm Morella Fernandez. Thanks for joining us here on Market Call. Greg Newman on the show today, Senior Wealth Advisor and Portfolio Manager at Newman Group ScotiaMcLeod. He's taking your questions today on North American equities and dividend stocks. Here's how to reach us. Call 1-855-326-6266 if you want to have your question live. You can also email us, BNN at Bloomberg, or Market Call at BNNBloomberg.ca. Greg, let's start talking a little bit about all of the latest changes we've seen in the environment. Yeah. So apparently a positive call today between the American president and our prime minister. Do you think that might dial down a little bit of the craziness we've seen?
So, great question.
I'm going to take that as a no.
No. You know what? I do think that after that call, the Dow was down maybe 550 right now, and the Dow did rally back a little bit to maybe being down some 350. I think that it's enough to maybe arrest the development for maybe a steeper dive in the stock market. I think that stock market participants are getting tired. I think that there's protest votes going on with against U.S. equities, and I think there's just so much opaqueness here that people are just are just scared of Trump, and you're seeing them pull back. And the odds of, we saw data today in the United States, PCE, and we saw consumer sentiment, and inflation is sticky, and consumer sentiment is weakening, and a lot of this has to do, I'd say most of it has to do with this tariff uncertainty. And I think that really the market participants really understand very well in the world, hey, China hasn't really treated the United States and the West too well. Canada really has. And so, if the market starts to see better behavior towards Canada, I think that is a positive.
Okay, so, and that we don't really know until maybe April 2nd and 3rd.
Well, April 2nd, and, notice the words and language of President Trump, who said, well, Carney and I will talk about this more after the election. So implying a lot there with just a few words. So, look, a lot is going to happen April 2nd. I suspect at the end of the day, you're going to get very big car votes for Canada. I do. And I think that at the end of the day, most of this, too, shall pass because it's in the United States' best interests. So, if you look at their overarching plan that I've been saying about since 3-3-3, 3% GDP growth, never going to hit 3% GDP growth in tariff wars. So tariffs appropriately and in targeted places, yes. Pervasive across the board, 25% applied to Canada. I think a month or two from now, we're not going to be dealing with that.
So it's funny because Canada has been the direct target now for so long. Yes, he says things about Greenland. Yes, he says things occasionally about Mexico and China. Yep. But he really seems to have his sight on Canada. But you still think we could, I'm going to say, get lucky and get at least some carve-outs.
Well, I think it's not about him being nice to us. I think it's what's in their best interest, number one. Number two, I think it's deliberate that he's toughest on us. And he's kind of showing, look, if this is what I do with my family and my friends, imagine what I can do with you. Mm-hmm. So I think that there's some sort of method to the madness. And look, maybe I'm an optimist. Maybe 3 months from now, we're still going to be dealing with really hard, big, large, staying tariffs, but I don't think so because I just, we're going to have a recession if that happens, probably, and the stock markets are going to come down more, and his base is not going to be happy, and recessions take a while, and the midterm elections are a year and a half away, so it doesn't add up, but a lot of what this administration has been doing so far, people will question, has it been adding up thus far? So there is a lot of confusion.
Okay, so we will talk a little bit more when we come back about how you're approaching all of this, right, as a manager who's helping people with their investments. Greg Newman is portfolio manager at Newman Group ScotiaMcLeod. So he's going to take your questions on North American equities and dividend stocks. We'll start when we come back. Stay tuned. welcome back. Thanks for joining us on Market Call. We have a viewer named Greg who has sent in a question. He says, could I please ask for Mr. Newman's views on Gibson Energy? Gibson Energy.
You know, I do like this stock, and doesn't get a lot of respect from the market. And I like this whole energy infrastructure space. I think that it's one of the places that you can hang out here, you know, along with gold, and along with, you know, yield, bond proxy. You know, the Q4, they had a marketing loss, and the market didn't like that. But that's only 11% of their actual net asset value. They raised their dividend by 5%. They just did a deal with Baytex, which is accretive somewhat, about 1%, adds to their stable long-term cash flows. We really like their infrastructure growth, and that was on display in Q4, importantly. Strong balance sheet, low payout ratio, very high dividend. And when you shake it all out, this is a very cheap stock at under 12 times, about 11.7 times 2027 PE, and modeling about 14% earnings per share growth. So this is a name that I'd be actually buying here.
And holding for the long term.
Yep.
Got it.
Yep.
Okay, let's go to the phones. Michael is on the line. He has a question today. He's calling us from Vancouver. Hi, Michael.
Hi, Marella. Hi, Greg. Greg, thanks for taking my call. Greg, my question is on Rogers. It's now down below $40 here. Just wonder what your thoughts were on Rogers, and possibly give a little outlook on the Canadian telcos as a whole. Do they a buy, sell, or a hold? That's got her for now. Have yourselves a great weekend.
Thanks very much. So a lot of questions about the telecoms moving forward. Where are they now? A lot of them have been sort of sinking, and where is there capacity for them to grow? So Rogers Communication at $39.24. Today, down 1.2%, and looking at the 5-year, down 30% over the 5 years. They bought, of course, MLSE, the bigger stake from Bell.
Right.
Some people didn't take too kindly to that. They didn't think it was necessarily the investment they needed to make. What's your take on Rogers?
Listen, I think this whole area at this point is a buy. You know, I think that BCE is probably going to need to cut their dividend, you know, and that's, but I think that could actually be a catalyst for the stock at this point. Rogers, I think, is a buy. You know, TELUS, I think, is a very strong buy here. Look, 4 telcos, you know, instead of 3, CRTC headwinds, balance sheet issues that plagued all these, that are plaguing all these people, all these companies, and asset divestitures are what's going to happen. But all those catalysts, I think, are going to happen, and I think that most of the bad news is in. So if you're looking for stocks that, you know, if we're going to have falling markets, one of the good things about having some negative positions in your portfolio is they tend to not be the ones that get sold when markets get worse. They actually just they're kind of washed out. So I think Rogers is probably there. Of all of them, TELUS is the one that I'd be buying right now, and I actually would be buying that.
Got it. Okay. BCE, of course, the parent company of BNN Bloomberg and CTV News under the Bell Media banner. Let's go back to the phone lines. We have Rob on the line from Calgary today. Hi, Rob.
Hi. Thanks for taking my call. I'd be interested in hearing Greg's opinion on Power Corp. It's been pays a nice dividend, and I'm looking for Greg's take on its growth potential, or if he has a better suggestion in the financial space, I'd be very happy to hear about it. So Thanks again, Marella and Greg, and have a good weekend.
Thank you. Let's pull up Power Corp and have a look.
So, you know, we've been moving money into this name, and it's got a great valuation. It's got a holding company discount. It's got a decent growth rate of, say, 6, 7, 8%. Throw on a real nice, good dividend on top of that with a very low PE. And it's one of these places that you can kind of hang out. The only problem is that in bull markets that start to give way to bear markets, people look for places to play. They look like, okay, and they say, okay, I can't buy these other areas. I can't buy the banks. I got to find areas that are immune from tariffs. So I think money has kind of swelled into names like Power. So if you see markets right themselves, and people start going back into tech again because the economy is good, you're going to see names like this fall off. If we actually go into a real downturn, you're just going to see money just leave the market, and this is going to go lower as well. So what I'm saying is that technically it's a little bit over its skis, but I do really like the name long term. You're going to win longer term. But do I think that you're going to get a better entry by trying to buy it at 44 or 45? Yeah, I do.
Okay, it's just one of the few we get to see these days that is going up in February, March, as opposed to going down.
It's a pretty natural phenomenon, as the people, objects resist motion. And all of a sudden, when you go from a bull market to maybe what is possibly a bear market, or at least corrections, people don't give up. They want to, rather than go into 3% money market, which is sometimes the best thing you can do if markets are going to go down 10, 15% in registered accounts, not paying 26% capital gains. They look for areas, and those areas get smaller and smaller and smaller and smaller, and then those areas fall out. That's a classic bear market. I'm not saying we're going to get there. It really depends, honestly, on what the U.S. administration does.
And we don't know what they're going to do.
Yeah.
Okay, thanks for that. Let's go back to the phones. Paul's on the line from Toronto. Hi, Paul.
Yeah, hi, good afternoon. I just like to know about the stock Alphabet. It is around 157, 158. So what is a good price to enter the stock? And thank you both for taking my call.
Thank you.
So listen, in normal times now, they just had a 9% revenue miss last quarter, big CapEx in AI. The market's worried about that, but their earnings were up 28% year over year. Very high demand for their AI products, they say. It's a great company. Not expensive, trading at 14 times 2027 PE. That's the market multiple is about 20. So this is a lot cheaper than the market, and it's growing around 14%. So normally, this is a time when you'd be buying a name like that. I think one of the reasons is people are concerned about growth. They have advertising, and without being impacted if we're going into a growth scare or worse. And I think that people are also protesting against the U.S. and against the Meg 7, and they're just saying, forget it, I'm just going to sit out. So, I think that this name could get a little bit cheaper, but there's great value here. And if you're looking out 5 years, is now a good opportunity. It is.
Okay, so if you're looking longer term, definitely you can dip in. Do you think it's going to sink even lower than it is now? Again, we don't know.
Yeah, no, that's a fair question. I'm on this show talking about these things. Yes, markets always overdo everything. They overdo everything to the upside. They overdo everything to the downside. We've been in a period where these Mag 7 names have been very, very crowded. You're in a period right now where people all around the world are not happy with the United States and maybe picking on this sector. And will that get overdone? I think that if the administration doesn't pivot, yeah, I do. So I wouldn't go full scale into Alphabet here if you have a little bit of capital, but I would do some incremental purchases, yeah.
Got it. Okay, we are going to take a quick break. Greg Newman sticking around, portfolio manager, Newman Group ScotiaMcLeod, taking your questions today on North American equities and dividend stocks. We're back in a moment.
Making sense of business and the economy can be tough. We dig through the details to tell you what you need to know with straight talk and expert analysis so you can make informed decisions about your future.
Taking Stock, Fridays on BNN Bloomberg.
Welcome back, and thanks for joining us here on Market Call. We want to go right back to your phone calls. We have Tony on the line from Topsail, Newfoundland. Tony, what is your question today?
Hi, Greg. I'm interested in BEP-UN and or BEPC, Brookfield Renewable, for long-term hold. I don't really trade much. I do reorganize, if and where necessary, and give your opinion on in the registered and non-registered accounts. Thank you.
I like the fact that he said he reorganizes every once in a while, which we all need to do.
Hey, I like that. You know what? This is good. This is a good name. First of all, they were just very bullish last quarter on future growth, increased electricity demand. Their scale allows them to mitigate, the company says, tariff risk because they can source a lot in the United States. So they're sort of insulated from that. And they're doing really well with data centers. And the trouble with this name in the past is it's always been kind of expensive. But right now, it's around 10.5 times 2027 price to AFFO and growing at around 10.4% with a nice dividend. So, you could own this in the registered account, get tax-free, distributions, or you can own this in the non-registered account. I do like this. I think this is a very high-quality way to play the decarbonization space. So, maybe these yield proxies, same comments that I just said on power, have swelled a little bit. So technically, they're a little bit over their skis. So if you really want to be cute, you could probably buy it at $36, $35, but there's long-term value in this name.
So
right
it might be worthwhile waiting for a little bit of a dip at some point to dip in and then...
Crazy things are happening in this market right now, right? So money is like flowing into one area, and then if we see positive data on Tuesday, for example, the rest of the markets that have been laggards are going to swing back, and this area will come down. So, choppy environments are usually good trading environments. So, you're going to get this name cheaper.
Got it. Okay.
Yeah.
Let's go back to the phone lines. We have on the line from Victoria, BC, Alan. Hi, Alan. What's your question?
Oh, good morning, guys. My question is on Exchange Income Corporation and what Greg thinks about their growth going forward with their subsidiaries over the next couple of years. Thanks.
Thank you.
Great question. They just bought Canadian North, which is another aviation company. Their business is, I think, 80% aviation, 20% manufacturing.
Okay.
This looks like an accretive buy, easy to integrate for them. This is never really an expensive name. Right now it's trading at around 12 times and growing at around 16%. So kind of a protected, same comments though, money's kind of flowing into the safer areas. Their balance sheet is good, 2.7 times net debt to EBITDA, 68% payout ratio, probably going to be boosting their dividend over the next year or two. I like it. The only thing is again, if we're in for rocky markets, March tends to be a time when money's gone in RSPs, people are looking for investments. All things being equal, you're probably going to get an opportunity to buy it a little bit cheaper.
You mentioned that about 80% is aviation. The other part is manufacturing. Do they manufacture in sort of aviation or something else?
No, they're kind of balanced and they do other things. But their real growth engine is from being in the north and having really, really good pricing power.
Got it. Okay, let's go back to the phone lines. Andre is calling us with a question today. Andre, what's your question?
Hi, thanks for taking the call. I'd just like to get Greg's opinion on the upcoming merger between Whitecap and Veren and what the future might hold for them.
Listen, I think that this looks like it could be really accretive, and these are two companies that are reasonably priced with nice dividends, and I think the combination together could be better, so will be better for them. So I do think that that it's exciting, and I haven't seen the terms of the deal exactly yet, but the idea of it, I think, sounds quite good.
Okay, so Whitecap took a bit of a hit when they first announced this, and it's still pretty down. Veren seems to be doing better, I guess?
Usually the acquiring company, the one that's doing the acquisition, its merger arbitrage goes down. The other one kind of stays the same. So that's probably what it is. I haven't actually studied the specifics of the integration, but both companies haven't done exceptionally well, and they've kind of been marginalized players. So I think scale can really help them both if it's done well.
Got it. Okay, we are going to take a quick break. We're going to stick around to take your phone calls, and Greg's going to stick around to give you some answers when we come back. Welcome back. Time now to take a look at past picks. These are Greg's picks from May 15th of 2024, well before anybody knew that Donald Trump would be in office, we should add. So at the time, you picked Amazon, And Amazon at the time was at $185.99. Now it's at $194.50, and it has, of course, dropped at the start of the year, like all of the other tech stocks here. So, but it's still up 4% return and 4% total return. What do you see moving forward for Amazon?
So, the setup for this name was incredibly good, and at the time they were trading at a bit of a discounted valuation. We were looking for execution in terms of catalysts. I think that all played out. I think that it's kind of frustrating because the reason why the stock is down here is really nothing to do with itself. It's got more to do with the macro, as discussed. I mean, their recent quarter, they beat. Their general margins and operating costs beat. AWS is really growing with great AI tailwinds. I guess the one knock on the stock would be people are maybe concerned about the level of AI spend. It's about 35% of their CapEx. But same comments I just had for Google. I mean, this is a name that's growing at 20% here, visibly, trading at around 20 times, 2027. This is where you want to buy. This is really where you want to buy if there wasn't this other macro noise. But, things can evolve worse. Their outlook could clouden if the administration doesn't pull back. But, I do think it will. And I think that either way, this is a good long-term name at these levels if you just want to buy here and forget about it for 10 years.
Yeah, if you can approach it that way, right? Because you don't want to watch it for the next little while because, as you said, we don't know what's going to happen.
Right. We don't. Yeah.
All right, let's go to your next past pick. Again, this was May 15th of 2024, and it was Manulife at the time. It was $35.55, now up to $44.20, so very nice 24% return. In that time, a total return of 29%. Do you remember why you picked Manulife then?
Yeah, I always remember the reasons for everything. I mean, at the time, it was still trading at a discount to the group, and I think it still is slightly, but they were having less noise with their earnings. They were executing a lot better. Indeed, Q4 was just a nice beat. Asia and wealth just beat. This name does provide some shelter from tariffs, so people are going into it right now. Sun Life, one of their big competitors, they're the ones that have had the negative surprises twice in the last year. So still does trade at a slight discount at around 9 times, growing at around 12% with a nice dividend. This is still a buy, but caveats that, there is a swelling into this area, so you're probably going to be getting it at a lower level.
Is this the kind of stock people are moving to because they're seeing the volatility elsewhere and this is a little more reliable?
Exactly, and, there's, a little bit of a trap in there because, all of a sudden the world is okay, and then that area is going to come down. But you know what? If you're playing for the next long 5 years, I mean, this is a great dividend name, great compounder from here. Story just keeps getting better.
Got it. Okay, let's go to your third pick from May of last year. It was Intact Financial, IFC on the TSX, recommended at $226.10. And now up to $286.71, so a very nice 27% return here. And 29% total return, so a solid dividend there as well?
Yeah, so, it's a decent dividend that they just raised, I think, for the 20th year in a row. Just on their Q4, very strong underwriting in spite of a year of really high catastrophic losses, really shows to just how resilient this business model is. Great ROE, 16.5. I mean, look at one of their competitors, Definity. In the P&C space, I think their ROE is down around 10. So these guys are in a class by themselves. Getting a little bit pricey here, 16 times for 10% growth.
Okay.
I would buy this name on a little bit of a pullback. I think that it's, a little bit technically slightly overbought here, but the quality is definitely there.
Again, one you can hold on to for quite a while.
Yes.
Okay. We are going to leave it there for now. We want to get back to your phone calls for Greg Newman when we come back. Stay tuned. Welcome back. And again, thanks for joining us. We want to get back to your phone calls. Ron has been holding on the line. He's calling from Victoria, BC. Hi, Ron.
Good morning, you two. Greg, a few weeks ago, you recommended Kyndryl Holdings, KD.
Yep.
Just wanted to know if you were still positive on the name. Thank you.
We are. I have to say, though, when it rains, it does pour. And, this name's come down because of the NASDAQ and all that's been associated with that and the macro. However, there was also a short report that came out, Gotham, that came out on their accounting. So questioning their accounting. And we summarily disagree with the author's view. So, a lot of times these short guys are kicking around. They're looking for something soft. Sometimes it's right. Sometimes it's wrong. The stock did sell off. And often there's enough room and distance when they initiate their short to make their money and go away. So listen, we'll find out. We do disagree with the findings. We think that this is a great company, spin out from IBM, lots of future demand, buying back their stock, trading it around 11 times and growing it around 65%. So I don't know that there's anything better that you can buy in the stock market right now, other than maybe a name like Propel. But listen, growth names in periods like this can get crushed. Markets overdo everything, and it could get a lot worse.
But you'll be holding on to it
Listen, if you're on leverage and you own too much of this name, and this is your only name, or if you're leveraged, you got to be concerned. But if you're owning pieces of this name in a proper portfolio, you want to be buying some more here.
Got it. Okay, time to dip in if you have that to do. Let's go back to the phone lines. Robert's on the line. He's calling us from Winnipeg. Robert, what is your question today for Greg?
Good morning to both of you. And Greg, you're one of my favorites. My question's on the natural gas biz. You talked about Gibson earlier, which interests me a lot, considering the pipeline and this system that they have. My question would be on whether or not you like Peyto or which one you would prefer. Thank you. Bye-bye.
Well, that's a great
question.
Listen, they're both great companies with great dividends here. Obviously, I think Gibson is a lot less risky. Peyto, they are dependent on AECO to a certain extent, but they've hedged a lot of that out for the next couple of years.
Okay.
But beyond that, they have a lot more risk. But look, their Q4 was in line. Their operating costs were down 8%, and their production was up. And this is what you want to see. You want to see lower costs, higher production. And 2025, they called for 6% production growth. I like the whole natural gas space. I like the Canadian natural gas space as we get more offshore, and that's only going to accelerate here. So I think Peyto is one of the names that I like within the space, along with ARC and Advantage.
Do you worry about the tariffs on energy that we are getting from the U.S., and there is already a sort of tit-for-tat grounding underway with Ontario?
I've been worried about this for, 15 years, 10 years. Just look at AECO prices and Western Canada Select versus U.S. prices. So, yes, another 10%, but our currency is kind of adjusted. 10% is kind of peanuts relative to the discounts that we've had due to the choices that we've made not to build out our infrastructure for years and years and years. So I think that we're coming to a better resolution in that space, and that's going to benefit companies like Peyto.
Got it. Let's move back to the phone lines. Jim is calling us from Elliott Lake. Hi, Jim.
Good afternoon. Greg, just wondering your thoughts, I guess, with gold in general, and if you've got a senior gold name that you would like today.
Would you buy in with gold at this point? It's expensive, right? And I know people are moving in because of the time, so it's swelling like a 3,118.
Well, you have to really respect a chart like that. When you see a chart like that, you know that there's another side. And there's probably a head and shoulders it's going to carve out, and it's probably going to fall. You're probably going to see, if I had a gun in my head, I think, in the next month, you're going to see Trump roll back a lot of this stuff. And I think that you're going to see the economy do better and the rest of the market do better. And areas like gold are going to sell off a little bit. That would be my guess. But are the Chinese buying long-term directionally. Our central bank's buying long-term directionally. Yes, I think gold still is a good theme, and I think if interest rates do continue down, and we're getting some question on that with inflation today, but yeah, I think that all benefits gold. Now, have the stocks moved? Agnico Eagle certainly has. That would be our favorite senior. Barrick's got some hair on it, but it's been pretty cheap, and we've been owning that one. So that's been pretty well. And in the kind of more intermediate space, I would go with Alamos. But gold is a remarkably frustrating area because, there's cost inflation, there's operational problems, there's jurisdictional problems. So we're always about being efficient. We're just not, we're stock guys when we see the advantage, but sometimes it's okay to be in the index. So if you got U.S. money, GDX, GDXJ for the juniors, XGD in Canada for Canadian dollars, nothing wrong with owning the indices too.
Got it. Okay. Let's try and get another caller in before break. Anita's on the line from Markham, Ontario. Hi, Anita.
Hi. Thank you so much for taking my call. My question is on Propel Holdings. It was doing so well last year, and the stock has dropped suddenly. What are your thoughts on this company going forward? Is it a hold or a sell? I'll hang up and listen to you. Thank you.
Yeah, listen, this is what markets do. Their earnings were pretty solid. I mean, most metrics were better than expected. I think they missed on their core EPS by 2 cents. Look, I think that the reason why growth names are really getting smashed here, people are pulling out, and this name has an enormous ability to grow. And there's really nothing wrong with it. It's trading at around 6 times 2025 with about a 35% growth rate. People are concerned in recessions or in growth scares, people have less ability to pay back their loans. So PCLs is a bit of a concern. And then, people are concerned about the health of their businesses. But, 90% of their business is in the United States right now. They're growing in Canada. They're growing in the UK. Look, Anita, if we're going to go into a recession, which I don't think we are, this name's probably going to get worse. But I don't think we are. And this name is a really good name, given the setup right now, given the valuation, given the execution, and given the market. So if you're owning it in a non-registered account, try to buy more.
Okay. We do have to take a quick break here. Back with Greg Newman in a moment to take more of your phone calls and your emails. Stay tuned. Welcome back, and thanks for joining us. Let's go right to your phone calls. Paul's on the line from Toronto with a question for Greg. Hi, Paul.
Hey, guys. Great show. Greg, quick question for you. I'm considering establishing a position in Canadian railroads, and I know both CN and CP have come off quite a bit. Just wanted to get your thoughts if you had a choice there for either of them. Thanks.
Well, I think CP has more catalysts, with the merger still quite accretive, better growth rate. Both of them are getting a little bit more attractive. And, if we get it all clear, they're both going to be decent entry points here. But between the two, I think CP has a more compelling price to growth, and that's where I would go. I'm not ready to. Yeah, listen, if I'm right that April proves to be, and that's just a gun to my head, then, this would be the time to buy. But I'm a little bit afraid, and I wouldn't be stepping in quite yet.
So because we're in the tariff situation and we don't know how much shipments across that border are going to be affected, yep. Steel and aluminum already tariffed, is that where your concern comes through? That's
part of my concern, but also just demand. If you're having slower growth or growth growing in reverse, traffic moves less. The other thing to think about, though, if we're doing more in Canada interprovincially and if we're getting more offshore, maybe that could be a benefit at some point. But that's on the other side. And, so I don't think either of them are priced for a downturn if we have a downturn. But I'm hoping that we don't have a downturn.
Okay.
Yeah.
Let's go to Sal. Sal is in Toronto and has a question. Hi, Sal.
Hi. My question was on Shopify. I know this is kind of a stock that has a lot of volatility, and normally it has a rich kind of valuation. So now that it's come off quite a bit, and thinking about the latest earnings report, I was wondering what your thoughts would be to start an entry point now in Shopify. Thanks so much.
Yeah, so it is around 139, 140.
Yeah, listen, this is a growth company that has not been smashed, really. I mean, it's come down a little bit from its highs, but they're flirting with getting them within the NASDAQ 100. And so that's been one of the reasons why the stock has really had a big move. Because if they get on there, there's going to be a lot more buying. Listen, their earnings last quarter were good. Their general merchandise value is very large, beat significantly. Subscription revenue was up. There's nothing not to like about this name. It's executing. It's where you want to be. The only trouble has always been just how pricey it is. 23.5 times full year 2026 versus peers that are at around 2 times. So this is really, really expensive on a PE basis. Little bit better at around 46 times 2027 and growing 24%. This is a must-own name. But I think you got to buy it at the right level, and we own it. This was a top pick of ours on this show. I don't know how many splits ago at $38 in 2016. So, we still have some from that time, fortunately, but it's very whippy, and it is. You want to use the technicals to buy this name.
Okay, so you would dip in right now, then I guess. I mean, it has come down.
No, I wouldn't.
You wouldn't at all.
Well. I own it. That's great. I'm not going to sell it.
Yeah.
No, I'm going to look for a better opportunity to get in the lower levels.
Okay.
Yeah.
All right. Let's go back to the phone lines. And Gordon's on the line from Lethbridge, Alberta. Gordon, what's your question today?
Hi, Morella and Greg. Greg, is Lightspeed a screaming buy, or should I avoid it? And my second question for you is, why doesn't Shopify buy them out?
Well, hey, you know what? Sometimes our greatest ideas come from smart people and smart callers and smart clients. I didn't think about that one. Should you be buying Lightspeed here? Look, they just came out and they lowered their outlook, and all the analysts have been downgrading them. They're really trying to focus on North American retail and European hospitality. It's not what the market expected, not what investors expected. That said, should you be buying it here? The question is when to catch a falling knife. Look, I do think you can buy it here, yes. And I think that this one has gotten sufficiently marked down. I would rather write a put on it, oblige myself to own it at around $10 maybe and get paid a real nice premium. So I won't really take the risk, but I can get some upside. Look, we're still modeling 21% earnings per share growth and trading it around 20 times. So I do think that you could step into this one with some little bit of capital.
What's the competition in this space?
So they're payment systems. So what they do is when you go and you pay from the restaurant and you tap and you pay, and in hotels and in restaurants, and that's really what the market is. So there's other guys that are doing the same sort of thing. But they've chronically been cheaper than their competitors in the United States.
Got it. Okay. We do have to take a quick break. That's all the time we have for your questions today. But stay tuned. Greg is going to share top picks when we come back. Welcome back. It is time now for Top Picks with Greg Newman. We'll take a look at his first one, which is TELUS on the TSX. I will also pull up a chart and see where TELUS is today. Why do you like TELUS? Because there's not a lot of commitment these days to the telecoms.
I'm going out on a limb.
Yeah.
I'm going out on a limb. You're trying to pick a bottom, which is always really hard to do. I'm looking for a name that is probably washed out, multi-year lows. What's the culprit? The culprit is too much debt, as we just discussed on the break, CRTC decisions that haven't been perfect, 4 carriers instead of 3, and all of a sudden a world where we're facing less immigration, which in Canada, which was a real tailwind for growth. But you know what? You can get an 8% dividend on this name, which I think is safer than BCE's. A much more reasonable valuation than it's been in years, around 15 times. 2025 is not a great year, but decent growth beyond. More modeling about 13%. And when you stick on the growth rate with an 8% dividend and with catalysts like asset sales, like towers, and a credible path to get their balance sheet better. I mean, people are always asking me, what is wrong with these telcos? Well, it's their balance sheets. So if you can get their balance sheets in better shape, I think the stocks will work. And I think that I'm trying to find things that are pretty washed out. I think TELUS is one of them.
Okay, so did it change your mind, or did it add to when they announced that they wanted to sell its tower, its stake in one of its towers?
Well, I think that's part of the catalyst. I think that's one of the reasons, the market's been pretty choppy in the last couple of days, right? And TELUS was maybe below 20 yesterday, and maybe today it's 20.40, but it's been making its way up. I mean, this is something that investors are looking forward to.
Yeah, and they want to retain ownership rights, meaning they'll own more than 50%. They want to sell 49.9%. You think they'll get interest from the U.S. on this?
That's where the interest is coming from to buy those towers. Yeah, those are great moneymaker. They're kind of like a REIT, like a bond proxy, those companies. And capital, they can use their capital better than having them in infrastructure like that.
Got it. Okay, let's get to your second pick, which is AltaGas on the TSX. What do you like about AltaGas?
So many things. I mean, one, I'm looking for places to hide out, that are a little bit immune from the tariffs. High growth in both utilities and in midstream. Higher utilization and system improvements. And Q4, they announced the next wave of growth projects that wasn't in the market to the end of the decade, so it got a nice little boost on that. Increased sales of Canadian propane, expansion of Dimsdale gas, expansion of the North Pine fractionator. Beyond that, there's Pipestone and there's Reef in the end of 25 and 2026 for growth opportunities. Decent dividend, not like Gibson, but grows at a nice 5% a year that we forecast. And even though the stock's had a real big move, it's still trading at a discounted valuation. It's still trading under 14 times. So 13.9 times 2027, 10.5% growth rate, 3% dividend, price to growth, good, in an area that is kind of safe and immune slightly from the tariffs.
I like that. Safe and immune slightly from the tariffs, mostly from the tariffs, I guess, at this point.
Mostly, but the reason why I say that is, money, it's all connected, right? And if money flows out, everything kind of can come down. Yeah, eventually.
Okay. Let's get to your next pick, Brookfield Infrastructure Partners on the TSX, and what do you like about the infrastructure side?
Well, they just announced 2 asset sales in U.S. gas pipelines and European data centers, and this gives them a lot of dry powder, and this is something, and the ability to build out their data center pipeline, and this is something that the market was concerned about, their ability to monetize and get dry powder in this environment. So they've been able to do that. Meantime, last quarter, which is a month ago or 2 months ago, they beat by around 5%. Strength in midstream, utilities, data, and transport. They boosted their distribution by 6%. These guys have inflation-linked revenues, which is really helpful if we're in this sticky inflation environment. And they got a real large backlog and robust deal pipeline. So data center growth is really a great piece of their growth, and they're very excited about that. When you shake it all out, always looking for names that are cheaper than they ought to be. 8.5 times 2027 price to adjusted funds from operation, and modeling about 11% growth. So you tack that on with a 5% dividend that they've been growing. We think they're going to continue to grow at 6% annually. This is a nice compounder.
So just for investors, again, who are very nervous about what's to come and what has already happened, it looks like you're sort of moving towards energy as the picks to take you forward and perhaps have a little less volatility than the others?
You mean of the 3 names in general? I wouldn't say.
Or how would you advise people at this point?
Well, am I looking for bond proxies?
Okay.
Yeah, that's what I'm looking for. I'm looking for things that can work if we have a growth scare or worse, that should do well. And names like Brookfield are very contrarian. Brookfield Infrastructure, you know, when things get cheaper, they have a lot of dry powder and they buy assets cheaper. So, you know, you can make money from bear markets. It's great. You know, if you're lighter than the average and you go down 3% when the market goes down 20, and then you can apply your capital on an after-tax basis to that, that's great. And if Brookfield Infrastructure does the same thing by buying assets cheaper, that's the kind of name you're getting here.
Got it. Greg Newman, thank you so much. We appreciate you coming in. We'll see you again soon. And that does it for Market Call. Have a good Friday. We'll see you again on Monday.